Thank you very much. So I think you've heard like the comments from previous speaker is generally very positive. So let's see if European and international investors are having the same views. So today I'm very pleased to be joined by Mindee Lee. So Mindee is Senior Manager, Corporate Strategy and Board Secretary at CPI Property Group. So we've heard a lot about CPI in the previous presentation. CPI is one of the largest, if not the largest, owner of hotels in the CE region. You own and operate hotels. You also own franchise hotel, and you own managed hotels. So quite wide, diversified portfolio in most of the markets in the CE. So looking forward to hearing from your insights. Phil Golding from Cedar Capital, your partner at Cedar Capital. You are veteran in hotel transaction in Prague. You've owned and sold the Mandarin Hotel. You currently own the Mama Shelter Hotel, which you converted from the initial Park Hotel. So looking forward to hearing from Phil, and you're also active in many transaction across Europe, so it would be good to hear your view on the specifics of the region. We have then Adrian Flück, who is Director of Alternative Investments, which I would understand are mostly hotels. Adrian is working at Invesco, so representing interest of an institutional investor who is active in the region. Invesco owns the Sheraton Hotel in Krakow. I know you've been looking at a few deals also recently in the region. I think your approach is mostly like focusing on leased hotels, so also quite different profile. And finally, but not least, David Musil, who represents Penta. So David is Business Director, Residential and Hospitality at Penta Development. Penta Investment. And Penta is big into developing mixed-use properties. You're currently developing a big one just next door with Zaha Hadid architecture, which is going to be changing very much positively the environment here. But you have done some hotels as well as part of this development. You own and sold the Motel 1 Hotel in Prague. You're currently developing and opening the Zlip Hotel in Prague 5. And finally, you will be opening a new hotel, the Cloud 1, which is a new brand from Motel 1 at the beginning of next year. So a lot of different profile, and all these hotels are leased basically, right? So maybe before going into the deepness of the topic and question, I just wanted to kind of come back of where we were last year. I mean, when I was sitting at IDEEA in Athens, the market was full of paradox in some way. Like you had a lot of equity in the market, but very few transactions. There were record performances in the hotel, but profitability were challenged because of utility cost and staffing costs going up. People wanted to travel, but a lot of flights were not available, cancelled or rerouted, so it was quite difficult. And then finally, the transaction yields were at their lowest, while the borrowing costs were going up. Where are we now, 12 months later? I think the market has changed a lot, especially on the yield side. So what was expected arrived. The yield have moved up. I think you've seen from Maksud's presentation that there's been at least 100 bips adjustment on the yield, in some markets much more. But I would say valuers, and I know that some are in the room are not going to be happy, but I think valuers haven't crystallized yet that market shift in many cases. The debt financing is scarce, and I think we have few debt providers in the room as well. They're still active, but it's much more expensive, so it has slowed down the process of transactions. But on the positive side, and it's what Thomas was referring in this presentation, the performances are very strong. And I think we are, these very strong performances that are coming down to the bottom line is helping owners of hotels to sustain their price and to kind of create a sales story when you present an investment to the market. And I think this is where we are right now. There is a bit of a momentum on hospitality, which has been driven by this this flow of positive market sentiment. So hopefully we will see more deals in Europe, more deals in the CE region. Mindee, if I can start with you. So as Musil was saying, you have been a large contributor of 2022 hotel transaction in the CE region through the acquisition of SIMO. Can you give us a little bit more insights on kind of like this deal, why this deal, were hotels that are part of that company were an important kind of decision to the purchase of the company?
So I'm glad to announce that CPI was, contributed a hefty deal to the investment volume for last year when we acquired SIMO. That was more of a corporate takeover process where we took over 88% of SIMO, which is listed in Vienna. The way that CPI had looked at the acquisition was more sort of holistic and strategic in the sense that their portfolio at that time consisted of office, residential, and some hotels. From a CPI perspective, the portfolio overlapped very much with our own portfolio. So CPI is also invested in hotels, residential, retail, and hotels. Now, being a diversified player as we are, and being in the same cities that SIMO's properties were, we felt very comfortable to acquire SIMO's property portfolio because we knew how to evaluate the different segments. I think what we saw was that SIMO and even IMO Finance, which we also did a takeover bid last year, the problem with the valuation or how investors had looked at the stock was slightly discounted versus the net asset value, partly because we believe that equity players didn't really know how to value or didn't necessarily like the diversified aspects of the portfolio. And also not to mention, IMO Finance and SIMO had a long history of this Gordian knot where they had cross ownership of each other, multiple failed attempts of takeovers as well, which probably added to the significant discount in their NAV. So all in all, I would say that from CPI's perspective, when we did the acquisition, while it was not necessarily focused on the hotel portfolio, because we are hotel owners, hotel operators as well, looking at their portfolio, we were very comfortable with the assets, and in fact, very beautiful assets that we would like to definitely take over.
And how did you manage to integrate these hotels within your existing portfolio? What has been the challenge?
Sure. So we completed the takeovers sometime last year in May and also in November of 22 for both IMO Finance and SIMO. And since then, we have taken on, as we have integrated our asset and property managements between the companies at the sort of more group level. So our office properties as well as retail properties. Now on the hotel assets, which I definitely believe requires more sort of niche knowledge and also more attention of hotel asset management versus how you would an office or retail portfolio. We've also started to integrate that into our asset management. So from summer of this year, CPI Hotels, which is our owner-operator entity, has started to take over and do more of these asset management for the SIMO properties. Although what I would say is that the SIMO properties are mostly managed or leased, but at the same time, we do believe that we can add value and create synergies from there, given our large size of the portfolio.
Excellent. Thank you very much. Phil, moving on with you and maybe coming back on kind of your long-term experience in doing deals in Prague. Can you tell us what has changed in the market, kind of like from the time when you were owner of the Mandarin and when you sold the Mandarin hotel to Chinese investors?
Sure. So just to give everyone, good afternoon, everyone. Just to give you some context, we've made 3 investments in this region, 2 in Prague and 1 in Hungary. I guess one could argue we were quite pioneering back in 2006 when we bought the Mandarin. It was on a forward sale basis from a developer. It's a converted monastery. And we found with time that we liked the left-hand side of the river in this city. At that time, the business plan was to stabilize the asset as a discount to the Four Seasons, which was the only luxury hotel player in town. And then the events of 2008, 2009 happened. And I think one of the lessons that we can learn today is one of the key things about being in the hotel business is trying to have the best ability to be able to hold assets and be able to ride out these challenging short-term blips that you get in time. We stayed with that asset, we recapitalized it. The first investment was painful, the second investment went very well, and then we were lucky enough to buy a hotel here called the Park Hotel, which we had a vision to bring a lifestyle brand to this city where we felt that segment of the market was very much underpenetrated in Prague, like many markets in Europe. And so we signed a deal with Mama Shelter. This was before Mama Shelter clearly became integrated into a much wider platform like it is today. I think some of the similarities of Prague and why we still very much like this destination, great accessibility, one of the top most visited cities in Europe, extremely high barriers to entry, which is critical for hotel performance. And then sadly, the mix between business and leisure remains what it is. I think a more healthy mix would be ideal for the market. But I think the major change for us when we look back over the last 15 years is really, I think Mags had said about these destinations are no longer emerging markets. And I very much share that sentiment. If you look at the ownership structure now in Prague as an example, you have clearly local, regional, but very much an international ownership group available, whether that's institutions, private equity, high net worth investors. So we think that the marketability and the investor appetite for Prague and many of the other CE countries is a lot greater today, and they're a lot more liquid than they were 15 years. That's from an equity side, but also on the debt side as well.
Yeah.
So back in the day, I'm showing my age, it was a lot more local financing based. Today you have a plethora, maybe we put the last 12 months slightly to the side, but you have a wide-ranging debt pool available for hotel transactions in this market. So I think it's definitely become mainstream, mid-Premier League, to use a footballing analogy, and we're very optimistic about the future.
Maybe looking at your acquisition of the Park Hotel and conversion to Mama Shelter, so like any tips or experience you had when it comes to turning around property and also bringing a new brand that was not existent or not known by many clients from the region. Is there any tips you can give to the audience when it comes to turning around properties?
Yeah, I think Prague's a wonderful city, and we're blessed when we walk around it and we all enjoy the architecture. And I think the city has done a really, really good job on the whole to protect what's so special about this destination. With that, obviously, comes some headaches when you want to change things. So, particularly when you have buildings of a historical nature or of an architectural interest. So I think whether it's Prague or any other market, it's about having local partnerships, making sure you assemble a professional team in terms of architecture, design, city planners, working really hard on those, and also working really hard on mayoral relationships locally as well. And then in terms of the brand, when we thought about it, I remember when we first saw a picture, you guys sold us the hotel, with the email came and we jumped straight on the plane and we came to Prague. We just love the architecture of the building. And from the get-go, we knew what we wanted to do. We wanted to create an engaging ground floor experience, and we thought Mama Shelter, with the experience of what they had done on the eastern périphérique in Paris, we saw many similarities. So that was really the thesis about the repositioning of a three-star hotel to a three-star hotel, maybe on steroids, with a really fun, engaging ground floor.
Yeah, thank you very much. You've done a good job here. Adrian, as I said at the beginning, like you've been active on investment in the region, like selling and buying hotels. Like last year, you sold the Mercure Hotel in Bratislava. You also own and do transaction in Western Europe, right? So like, what are the key differences of doing deals here in the region versus kind of doing deals in Western Europe?
Good morning, good afternoon. Hello, everyone. It's great to be here. Very good question, Fred. I think we are traditional, as you initially said in the introduction, we're investing into assets based on lease agreements. And oftentimes they come along with local partners. And that means we have an international brand, which we know, right? But we need to do quite a bit of due diligence on that middle level, that sandwich tenant, which pays us the rent and manages the property for us. And that is maybe different to Western Europe, where we know all the players, where we're based, where we have dinner and have events. We know them less here in Central and Eastern Europe, and I think that's where we as Invesco Real Estate are very fortunate to have two local offices, one in Prague and one in Warsaw, where we can really draw upon these relationships. And I think that's something really important to us, that we build this relationship and we can have these trustworthy partnerships with the local partners as well and build these over the years. When we look back on the investments we have now, we have these partners, or we have partners such as yourselves or other consultants in the region which can give us that confidence when we look at deals, when we underwrite investments here in Central and Eastern Europe. I mean, then it comes on top of it, we're euro-denominated funds, right? So we have the currency, which requires additional costs. The structuring isn't always that obvious. It needs a bit more work. If you think about Poland, where things are getting a bit more difficult. And so we need expertise on all sides, which generally make a deal a bit more expensive. But it's definitely still fun. I mean, I've started my career in Prague, and I have very fond memories of this city from many years ago. And it's always a place where we're looking at CE as a whole. Particularly the gateway cities remain interesting to us, particularly in obviously Warsaw and Prague.
Yeah, you talked about currency. You talked about white label operator, which I think like it's true. Like that segment is very much like growing. I think there are a number of white label operator in the room as well, and getting like much more experience, which I think is helping. Any other particular aspect of the CE region that are challenged, but also opportunities, right? That you.
Well, I think for an institutional investor, we look for. And we've talked about it before, we saw it on Thomas Emanuel's presentation, we look for a balanced, I think Phil also mentioned it before, a balance of demand across the week, segments, leisure, business, and the markets are definitely have matured. I mean, when I started here, Prague was a different place, right? We went to the GFC when I was here, right? So there's a lot of things have happened, typical owners left, the more international owners came back, and this is what we're looking for. We're looking for a market which is liquid, because, yeah, we're an international buyer, so we need to remain a certain liquidity in our funds, and that's why we look for markets which are mature, where we get that liquidity. So that's why we can't go into all the certain regions with our capital we have.
Yeah, makes sense. Thank you. David, moving on the developer side. So you develop few hotels, and I think you learn a lot from kind of this new type of real estate. What drove your decision initially to build a hotel within your mixed-use property?
Sorry, good afternoon. It was just luck. It wasn't any sophisticated decision. We purchased our building from S plus B Gruppe, and it was a brownfield, and we decided demolish and replace it by office building. And there was one building which we have to refurbish, and we kind of came to conclusion that we are not going to do the competition, the refurbished building and brand new building, and we inherited negotiation with Motel One, and we opened Motel One. It took us 2.5 years, 3 years. It was in year 2010. It was quite difficult, but at the end, I do not regret it. We did it. because I'm very proud that at the end we sold the building for yield 4.3. So it was a very good decision, but at the beginning it was kind of a luck in our decision process.
Yeah, it played quite well at the end, and then you continued actually, because you've added a sleep hotel in your scheme in Prague 5 and a Cloud 1 in Prague 1 that is opening very soon. So like, when you look at the current market situation, both kind of on office, resi, and hotel, like, do you, or would you continue doing hotel developments, like, or is this something that becomes more like a diversification age factor in your strategy?
I am director responsible for residential and hospitality, so I will support the hospitality in our office. We signed a lease contract with the Motel 1, the second one, which will be opening in April, and the Sleep with Deutsche Hospitality, we are going to open in November. Both of them are more complementary function. We are more office development, and really please free to visit our new brand office building developed by Penta and designed by Zaha Hadid. Just if you get out of the Marriott and turn right, you will see it. We are very proud for this building, and I would consider that we are leaders of the office market in Czech Republic. We also do the residential, and from time to time we do the hotel. My goal, my personal goal, we would like to do it more, and hopefully we have 2 train stations, Masaryk train station and Central station, under our control. We either own the land and have a right to build some more properties. And I am very positive that we will be able to find an agreement maybe with some of you for future development of hotels. So sorry for advertisement, I know a little bit.
This is a place to make business.
But you invite me for the panel, so I took the opportunity.
Yeah, you did well. Thank you. Mindee, you've been a net buyer for many, many years. I mean, when we've been speaking all the time, asking you and trying to convince you to sell properties, you were saying all the time, no. So you were clearly like a net buyer for many years. You've switched now, like I think probably from the acquisition of the SIMO and IMO Finance to a net seller. So how does it feel? Can you kind of tell us a little bit more about kind of why that strategy and kind of where do you see the opportunities?
Sure. So I would say that, we have traditionally been sort of net buyers. CPI Property Group is owned 90% by a single individual, and to some extent, hoarder of good properties. And we're long-term investors, so that's also one of the reasons why we've never really seen ourselves as sellers. We embarked on this IMO Finance and SIMO takeover with the intention to rebalance the portfolio after acquisition. So in our minds, we were already looking towards being sellers of certain assets where, for example, like lower yielding residential assets in Germany where we didn't necessarily like, or even sort of your sort of sub-market German office properties. And, back in the days, not really that long ago, but back then when we looked at it, large volume transactions were getting done. Easily, a couple of 100 million portfolios of residential or a big office tower could be sold to the likes of Vonovia or LEG Immobilien. Fast forward, the inflation and interest rate environment, things are not particularly supportive in that sense for those kind of transactions. However, lucky for us, we have a portfolio, a very diverse portfolio that is also very granular. So what we would have expected to do, one big transaction, couple of 100 millions in one go, we now have to pivot. So after the war and with the current environment, we pivoted to sort of smaller chunk size deals, smaller assets where it's more palatable to local investors and also the domestic players, which Maksud had mentioned just now. So we do see that there is still appetite, maybe not from the likes of the bigger institutional players, as they, have this wait and see attitude at the moment, but we do see that there is still a lot of appetite out there for the smaller bite sizes. The other thing I would also mention is that because of the diversity of our portfolio and investor sentiment for different segments like office or residential changes by the month. Today it's not necessarily offices that's flavor of the month. Then we pivot again to see what sectors is of keen interest to investors. And to that point, I think given the strong operational performance of the hospitality sector, we have seen a lot of interest incoming for hotel assets.
Yeah, you're currently on the market with a few hotel, some single assets, some portfolios. I'm not sure how much you want to tell us about the type of investor. I mean, you talk about the private investors, but these are, I suppose, for specific smaller assets. What about kind of the bigger transaction that you currently...
Sure, I can touch base a little bit about it. I mean, the process is still ongoing, so there's not much to necessarily update at this point in time, but we do definitely see for our hotel assets that's undergoing the process, there's very strong interest, especially with the good performance for the summer and the operational performance for this year. We do see a little bit more competition in terms of pricing and the investor interest.
Yeah, I think it's an important message because I think a lot of owners of hotels thinking, is this the right time to kind of put my hotel on the market? I mean, the fact that strong performances is really helping, kind of creating an investment story. And I think if you have the right product, you market it well, then there is definitely appetite and investors are around. And I find it's quite diverse actually as an investment profile.
Mindee, when you sell, what are you going to do with that cash?
Well, we do have, because of the acquisition, we do have quite a large bridge financing that we are looking to repay. So that's also part of the reason why we're a little bit of a net seller, because we have, to shore up cash to repay our finances.
Phil, do you see a lot of investment opportunities coming your end, and where are these opportunities coming from?
Yeah, I think we're impatient people by nature, and we're even more impatient this year, sadly. I think there's just a paralysis at the moment. On the one side, you've got assets kicking out income levels that have never been generated. So from a P&L perspective, it's very, very encouraging, and the runway's looking good. From the capital markets perspective, largely based on base rates as opposed to margins, debt financing just isn't what it was. So that obviously has just changed a shift in dynamic. I think what's really important to think about, the last 10 years we've all lived in zero interest rate, zero inflationary environments. So with maybe some slightly more perspective, where we are today is not abnormal in terms of long-term trends, but it's very abnormal to the last decade. And so that causes other challenges and things for people to think about and to work through business plans with partners and so forth. But I think we sit in the camp as being waiting in the sidelines, and we definitely think probably largely driven through refinancing maturity situations. There will be opportunities in the new year. We don't think there's going to be a whole glut of opportunities or a whole level of distress, but we think that the refinancing hard maturities will lead to situations. So from an investment perspective, you've got to be very careful how you phrase this. From an investment perspective, that will lead to interesting opportunities, but there's clearly going to be some challenging times on the horizon for folk.
And is there particular markets in Europe where you think there are more opportunities currently, or there will be more opportunities?
For wearing an equity hat, we've been most active in Italy and in Greece. Large transitional projects and pref equity. And we see that trend progressing with preferred equity, and we think that is a neat solution to these times when, quite frankly, I think we can argue till the cows come home about what a hotel's worth in this environment, because I don't think many people really know. So we're very much open for business on that side, but we'll be reactive to opportunities that come.
And you touched on the higher cost of financing, but how do you deal with that? Like, I mean, in some way it's linked to inflation, right? So, I mean, if we give a view that borrowing costs will stay high, then it's probably linked to the fact that inflation will stay high, and therefore inflation should be implemented into the cash flow, not just on the cost side, but on the income side as well, right? So
I think I'd partly agree with that statement. I would agree that top-line inflation has offset labour challenges and utility challenges, so the P&L is ahead of 19. No problem with that. Sadly, top-line revenue inflation nowhere comes close to offsetting the increase in base rates that we're seeing in western parts of Europe, and let's call it the UK as well, where base rates I think they're 5.25 today. They were 0 14 months ago. So that's a seismic shift. So we've got a hotel in London. Our debt service next year is 3 times what it was 18 months ago. Yeah. So no matter how wonderful inflation is, and we argue that all the time with folk about how good it is for the hotel business, it's not going to get close to offsetting debt service obligations.
Is there any question from the audience? I'm happy to take any at any time. Just raise your hand and the microphone will be given. Adrian, as we talked about, like you focusing on leased or you invest into leased properties, where you do that because you need to provide some security or so a certain level of stability to your investors. We've seen kind of the limitation of this model during COVID, and kind of a lot of investors realized that our leases are not just that secured at the end of the day. So where do you stand now? Like,
Well, indeed, I mean, it was a challenging period for everyone who did leases during COVID, and I think that goes back to the point of you need to really know the partner you're working with. You know, you need to understand who you. And in a lease, sometimes we call it's a marriage, right? You're entering a marriage for 25 years, and you need to know who you're doing that with, and you need to trust that person fully or that partner fully. And we've had good experiences and bad experiences, and to be very fair, and we have adapted our model that we have different securities. We continue to have the hybrid leases, which we really prefer. I mean, we've changed. We're now more maybe based on GOP. We've taken different angles to it. But to be honest, with the very good partners, we've always found a solution. We've had deferred rents. We got money back. It still takes some time. We still have some cash waiting to be paid, but it's coming back. And we enjoyed our partnerships with the direct brand relationships, because that worked really well, because it had a strong balance sheet, and we were able to make these commitments over a long period of time to give us back that money that they owed us. They didn't pay us during COVID. Yeah. So that has worked out quite well. And I think, and that's maybe another phrase, and I don't want to be making phrases, but I think it's really important to know your partner and to be able to rely on that partner. And I think during COVID, the partnership became stronger, because now we're in an amazing time. And we've got a few direct brand leases, some great tenants and brands, and we're now actively investing in the building together. We're really taking the money which we're earning now, because rates are high, profits are well, we're putting back into hotel, and we see really a great story going forward, and everyone is putting money in together to bring the asset forward. So I think we've really built a strong relationship during that period, and yeah, we're benefiting across the portfolio on this.
Good to hear. There was a question from the audience, if you want, yeah.
So ESG seems to be the big white elephant in the room in terms of real estate. So I wondered to what extent the investors... So ESG seems to be the big white elephant in the room in terms of real estate transactions and decisions. So I wondered to what extent do the investors take into consideration physical risk, transition risk, and how that's impacting their transaction decisions in terms of buying and selling. anyone but Adrian to answer the question, because I know exactly what Adrian would say. So Adrian is relieved from answering this one. But I'm very keen on understanding. I know Invesco is a leader in this area, so I know how they are really factoring this in, and you know, all credit to them. But I'm very keen on understanding how the other investors are doing it.
That's a nice, easy one for you.
Take that one.
So why don't I have a go? I see we've only got 2 minutes, so I'm not going to waffle on. In the US, there's 0. We've got 4 assets in America. ESG is just not a thing, period, which is fascinating because a lot of the US LPs into European funds are very hot on ESG. 3 years ago, we never knew what those 3 letters meant, and now it's one of the first things, if not the first, that we have to think about and understand. We're at base camp, looking up the top of the summit of the mountain. And I don't think anyone knows all the answers, but there's a hell of a journey for everyone in the industry to get their arms around where we've got to go on this ESG journey over the next 3, 5, 7 years. So I sound like a politician without giving you an answer, but there's a long way to go and no one's really got their arms around it yet.
I think I would add that, you know, ESG, for CPIPG, we try to be one of the front runners in ESG in the region. And in terms of how that impacts our investment decision, I would say that it does play a factor, especially now that, you know, with banks and financing as well, like this is becoming more and more of a focus. Also with investors, it is a focus. So for us to be ahead as a real estate player, we need to be on top of our game for ESG. So we do take that into consideration. It's not the only and, you know, maybe not the most important at this point in time, but it's definitely one of the key considerations.
Yeah, and from the agency side, like I can just add, it really depends on kind of like the investor profile. So the depends on the buyer. If it's an institutional buyer, it's going to be like very, very focused on the E part of ESG. But if it's a private investor, it's a very different story. So yeah. Thank you for your question. David, like maybe a question to you on kind of deal structure. Like you as a developer, you typically need to get security on kind of like the sale at the end of the development period. And a lot of developers have done forward deals in the past where you kind of like secure your buyer during the construction period. I know you looked at that in the past. You decided not to move forward with it. But kind of, what's your opinion about kind of the deal structure? And I mean, it's quite amazing, like for a developer, like looking at kind of the time it takes for a developer to finish building the product, especially in Prague, takes forever, right? So like, how do you kind of
we originated from the private equity, so we are quite flexible. We can do the forward purchase. We can wait until the 2-3 years of operation. Yes, we were discussing for Motel 1, the Cloud 1 forward purchase. At the end, we didn't receive the offer, which was sweet enough, and we will now wait until we will open. But we are developers, private equity, open for any discussion. But I would like to comment what Phil said. Financing is one of the critical issue. We were quite struggling to get financing, even though we are quite strong group. We are not only doing the development, but we have our own bank and pharmacy, etc. But to get a financing for the hotel is very, very crucial. And it was kind of a toughest issue for during the development process, and unfortunately, it also cut us our future profit.
Yeah. Is there maybe just time for one question in the room, if you want? Otherwise, I'd like to thank the panelists. No question. Perfect. Thank you very much, everyone. So please join me.